The stock market just hit a new all-time high, and I know what you're thinking. We have $36 trillion in national debt, a war in the Middle East, oil above $100 a barrel, and inflation that won't die. Banks are nervous, the Fed is confused, and every smart person you follow on social media is screaming that a crash is coming. So why is the S&P 500 sitting near 7,100 points like nothing is wrong? That's exactly what we're going to answer today. And more importantly, I'm going to show you the 4 invisible forces that are quietly holding this market up. Because once you understand them, you'll never look at a stock market crash as coming headline the same way again. Here's what most people don't get. The market is not supposed to make sense right now. It's supposed to be crashing. At least that's what the headlines want you to believe. But the market doesn't crash just because things look bad. It crashes when specific things break. And right now, those specific things are still holding. Barely, but holding. I've been tracking this system for a long time, and today I want to walk you through every single piece of it. No complicated jargon, no finance degree required, just the truth about how this machine actually works and what would finally break it. So, make sure to stay until the end if you really want to have a full, clear picture, and also a strategy to position yourself to benefit from what's coming. Leave a like and let's get into it. Let's start with the obvious question, because it's the one driving everyone crazy right now. The United States is sitting on $36 trillion in government debt. That's not a typo. $36 trillion. To give you a sense of how insane that number is, if you started counting to $36 trillion, one number per second, it would take you over 1,000,000 years. That's insane. At the same time, the Iran conflict pushed oil above $100 a barrel for the first time since 2022. Energy prices are feeding into everything. Food, shipping, manufacturing, medication. Inflation, which the Fed spent 2 years trying to kill, is starting to creep back up in ways that make the Federal Reserve very, very uncomfortable. And the stock market. The S&P 500 closed at 7,137.90 on April 21, 2026, a new record high. The Nasdaq hit a new all-time intraday high that same day. How is this possible? Most people look at that and think the market is broken or rigged or completely disconnected from reality. And honestly, that's a fair thing to feel. But the truth is more interesting than it's rigged. The truth is that there is a system, a set of hidden forces that has been preventing a real crash since 2008. And if you want to protect yourself, you need to understand these forces and what it would take to finally break them. There are 4 of them, and we're going to go through each one. And remember that the 4th one is the most important. First force, the Fed put, the invisible safety net. The first force is something Wall Street calls the Fed put. And before your eyes glaze over, let me explain this in plain English. A put is basically financial insurance. When you buy a put, you're protected if something falls in value. The Fed put is the market's belief. Not a law, not a guarantee, just a deeply held belief that if things get bad enough, the Federal Reserve will step in and save everything. They'll cut interest rates, they'll print money, they'll buy assets, they'll do whatever it takes. And this belief has been reinforced every single time the market cracks since 2008. In 2008, the Fed bailed out the banks. In 2020, they printed trillions of dollars, sent checks to everyone, and bought bonds like there was no tomorrow. The message every time was the same. Don't worry, we've got you. So now, every time the market drops, investors don't panic and run. They buy the dip because they believe the Fed will step in before things get truly ugly. Why does the Fed keep doing this? Here's the number that explains everything. U.S. household wealth is roughly $163 trillion, and a huge chunk of that, we're talking tens of trillions of dollars, is sitting in the stock market. When the market drops 40%, real people feel it. They feel poorer. They stop spending. Consumer spending falls off a cliff. A recession starts. And a recession makes everything worse, which makes the market drop even more. It's a spiral the Fed desperately wants to avoid. So, what is the Fed actually doing right now in 2026? They cut rates in late 2025. They're managing their balance sheet carefully. And here's the part they're not advertising. They're quietly buying assets. They don't call it money printing, they call it liquidity management and reserve purchases. Because if they called it money printing, people would panic. But it's the same thing. It's putting a floor under the market. The problem, this force has a kill switch, and that kill switch is called inflation. If prices keep rising because of $100 oil and Middle East tensions, the Fed cannot cut rates aggressively without making inflation worse. They'd be stuck, unable to save the market without destroying the economy in a different way. That's called stagflation. It's what happened in the 1970s, and it was brutal. The Fed eventually solved the inflation problem back then. But the solution was raising rates to nearly 20%, which crushed the economy in the process. The Fed put is real. It's powerful, but it's not invincible. Keep that in mind. Oh, and if you want to have more money to invest during this crash, remember that YouTube is on easy mode now, and it's blowing up every small channel that does things right, as I teach you in my free community in the link below. And join now, because when I reach 100,000 subscribers on this channel, there will be a very special surprise for those who are inside. And remember to subscribe to help me get to 100,000 subscribers in a few days. Thank you. Second force, the passive money machine. This is the force that most people have never heard of, and it might be the most important one. Right now, passive investing, index funds, ETFs, 401k accounts for more than 50% of all money in the US equity fund market. Bloomberg had predicted this crossover would happen by around 2026. It did, and it has completely changed how the market behaves. Here's how it works. Tens of millions of Americans get a paycheck every 2 weeks. A percentage of that paycheck automatically goes into their 401k, and the 401k automatically buys index funds. No thinking, no analysis, no is the market overvalued right now? It just buys every 2 weeks. Rain or shine, crash or no crash. Think about that for a second. This is a machine that buys stocks automatically, constantly, no matter what's happening in the world. When the Iran war started and the S&P dropped 9%, that machine was still buying. When tariff fears caused a panic in early 2025, that machine was still buying. When everyone else is selling, this machine never stops. And it's not just 401ks. Target date funds, pension funds, and automated rebalancing all create the same effect. There's a constant river of money flowing into the market regardless of conditions. This is why every single major sell-off in the last decade has turned into a buying opportunity in a matter of days or weeks. The passive machine cushions every fall. But here's the thing nobody talks about. This force can also be broken. The whole system depends on employment. If people have jobs, they contribute to their 401ks and the money flows in. But if unemployment spikes, say from 4% to 7% or 8%, two things happen at once. First, contributions slow down because people stop putting money in. Second, people start taking money out. They liquidate retirement accounts to pay rent, to cover medical bills, to survive. The force doesn't just slow, it reverses. And there's another thing building in the background. Baby boomers are the largest generation of investors in history, and they are retiring. They're shifting from buyers to sellers, from putting money into the bathtub to taking it out. That's a big chunk of money that used to support the market and is now leaving it slowly but surely. Third force, the algorithm engine. Most people think of the stock market as humans making decisions, analysts reading reports, fund managers picking stocks. But that picture is outdated. A massive portion of daily market activity is now controlled by algorithms, computerized trading systems that follow rules without any human judgment. These are often called CTAs, or trend-following funds. And here's how they work. When the market is going up, they buy. When the market is going down, they sell. They don't care about earnings. They don't read the news. They just follow the trend. Your first instinct might be, wait, if these algorithms sell when the market drops, doesn't that make crashes worse? And the answer is yes at first. But here's what happens next. Algorithms sell. The market drops, but the selling eventually runs out. Because algorithms only sell what they own, they have a finite amount to offload. So, the selling exhausts itself, usually within days or a couple of weeks. Then the market stabilizes. And when these algorithms detect stabilization, when the downward trend stops, they flip. They become buyers, and they buy aggressively. And then one algorithm buying triggers another algorithm to buy, which triggers another. It's a mechanical, automated snowball. This is a huge part of why every major sell-off in recent years has turned into a V-shaped recovery so quickly. The algorithms sell hard, and then they buy even harder. The S&P 500 just did something in April 2026 that it has only done 9 other times since 1950. It rallied 12.3% in just 13 trading days. That kind of speed, that's not humans doing that. That's algorithms. Fourth force, the options market hidden mechanism. This one is more technical, but stick with me because it's genuinely fascinating once you see it. There are financial institutions. Think of them as market makers whose job is basically to be the casino. When you want to buy insurance for your portfolio, someone has to sell you that insurance. These market makers sell options contracts to investors, and they make money on the difference between what it costs them to manage the risk and what they charge you for it. Now, here's the key part. These market makers don't actually want to take on risk. They want to be neutral. So they have automated systems that constantly adjust their positions to stay balanced. And here's the counterintuitive result. When the market drops sharply, these systems are forced to buy stocks. They have to. It's mechanical. It's not a choice. And when the market rises, they're forced to sell. This creates a dampening effect that smooths out the extremes. When panic hits and retail investors are selling, the options market makers are quietly, mechanically buying. They're not doing it because they're brave. They're not doing it because they think the market is cheap. They're doing it because their risk models tell them to. It's automatic, and it slows down crashes. Okay, so now you understand the four forces: the Fed put, the passive money machine, the algorithm engine, the options market mechanism. Together, these four things have created a system that is incredibly resistant to crashing. Every panic gets absorbed. Every sell-off gets bought. Every scary headline becomes a buying opportunity within days. The S&P has now delivered 3 straight years of double-digit gains, something that hasn't happened since 2019 to 2021. And right now, FactSet estimates Project S&P 500 earnings growth of 17% in 2026 and another 17% in 2027. That's not a market priced for disaster. That's a market pricing in a very bright future. But here's where I have to be honest with you. The Shiller-Cape ratio, which measures stock valuations relative to earnings over the last 10 years, adjusted for inflation, is currently sitting at nearly 41. The only time in history it was this high before, right before the dot-com crash of 2000 to 2001. That's not a fun fact. The second highest Cape reading in history means stocks are expensive by any historical standard. Not just a little expensive, historically expensive. The S&P 500 has never gone straight up forever. It will face a serious downturn at some point. The question is, what would it take to finally break the four forces we just talked about? There are 4 realistic threats, and you should know all of them, especially the fourth one that is the most destructive. First threat, the bond market. Right now, 10-year U.S. Treasury yields are hovering around 4.5% to 5%. If the bond market loses confidence in U.S. fiscal policy because of that $36 trillion in debt, or because of runaway spending, or just because inflation comes back hard and yields push to 6%, 7%, even higher, then something dramatic happens. Stocks suddenly have a real competitor. Why would you take the risk of owning stocks if you can get 6% or 7% guaranteed from the U.S. government? Money flows out of stocks and into bonds. And that's not a small thing. That's a major structural shift in where capital goes. Second threat, inflation's stagflation trap. Oil above $100 a barrel is not just about gas prices. Oil is in everything: fertilizer, plastic, shipping, medicine. If oil stays elevated because of Middle East tensions and supply disruptions, inflation doesn't come down. And if inflation stays high, the Fed put disappears. They literally cannot cut rates without making prices worse. They'd be choosing between saving the market and controlling inflation. And they've already said their job is controlling inflation first. If they have to sacrifice markets to do it, they will. The only thing you can do to stay safe is to open your YouTube channel now, since YouTube will not crash during a market crash. And I can help you in my free community in the link below. Third threat, the AI bubble question. The Magnificent Seven, Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla, now represent roughly 30 to 35% of the entire S&P 500 by market cap. This means your 401k is extremely concentrated in a handful of companies. And right now, almost all of the bull case for these companies rests on AI delivering massive returns investment. Amazon just announced $200 billion in capital expenditures for 2026. Much of it going toward AI. Microsoft is spending more per quarter on AI infrastructure than it used to spend in a full year. If the market starts to question whether this AI spending will ever pay off at the scale expected, if there's even a moment of doubt, like there was during the DeepSeek shock in early 2025, those 7 stocks could drop hard and fast. And because they're 30 to 35% to the index, the whole market follows them down. The Cape ratio at 41 is partly telling you exactly this. The market is pricing in an AI revolution that delivers. If it doesn't deliver on schedule, that premium gets wiped out. Fourth threat, the black swan. By definition, you can't predict it. A major cyber attack on financial infrastructure, a banking failure caused by hidden leverage, an escalation of the Iran conflict that closes the Strait of Hormuz and sends oil to $150, a pandemic, a sovereign debt crisis in a major economy. History is full of things that nobody saw coming, and the market has never been able to fully price in what it can't see. So let's summarize all that. Markets remain supported by four stabilizing forces: central bank intervention, passive investing inflows, adaptive trading algorithms, and options market dynamics. However, risks are elevated due to extreme valuations, persistent inflation, high oil prices, massive debt, and heavy aid-driven spending expectations. A crash isn't imminent, but overconfidence and lack of diversification increase vulnerability. Rather than panic, investors should monitor key indicators like Fed policy, inflation, bond yields, and earnings. If these weaken simultaneously, the stabilizing forces may fail, potentially triggering the long-anticipated downturn. Watch this video on screen to understand which compounding strategy you should use in a crash. Subscribe to help me get 100,000 subscribers, and I'll see you soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.